This recorded lecture covers assignments 4A through 4C in U.S. Taxation of International Transactions. As we've discussed, the U.S. tax rules can be divided into two general categories. First, we have the set of rules that applies to inbound transactions, where foreign persons are investing and doing business in the U.S. And second, we have the set of rules that applies to outbound transactions, where U.S. persons are investing or doing business overseas. In Chapter 4, we continue examining how the U.S. taxes inbound transactions. Recall that there are two regimes that apply to inbound transactions. The first regime is the one that imposes tax at the normal rates, that is, those in Section 1 for an individual or Section 11 for a corporation, on a foreign person's taxable income that is effectively connected with the conduct of a trade or business in the U.S. We find this regime in Section 871B for individuals and in Section 882A for foreign corporations. We studied this regime in Chapter 3. In this chapter, we're examining the second tax regime that applies to inbound transactions. Under this regime, foreign persons are subject to tax at a flat rate of 30% on non-business income from U.S. sources. The largest category of income that falls into this regime is investment income. We find this regime in Section 871A for foreign individuals and in Section 881A for foreign corporations. Let's use as our guidance Section 871A of the Code. Section 871A, and specifically A1A, imposes a 30% tax on the gross amount of certain types of U.S. source income received by foreign persons. In Section 871A1A, we see that this tax applies to interest, dividends, rents, salaries, wages, premiums, annuities, compensations, remunerations, emoluments, and, here's some key language, other fixed or determinable annual or periodical gains, profits, and income. This type of income is commonly referred to as FDAP income. That's simply a shorthand phrase that refers to the type of income that is described in Section 871A1A. Notice also the flush language of Section 871A, which says, but only to the extent the amount so received is not effectively connected with the conduct of a trade or business within the United States. If FDAP income is effectively connected with the conduct of a trade or business in the United States, then what happens to it? Well, then it's taxed under the other U.S. tax regime for foreign persons, the one we examined in Chapter 3, that imposes tax at the normal rates on taxable income effectively connected with the conduct of a trade or business in the United States. When we examined Chapter 3, recall that we concluded FDAP income is considered effectively connected to a U.S. trade or business only if an actual connection exists between the income and the trade or business. We found that the Code set forth an asset use test and a business activities test to determine whether there was an actual connection between the FDAP income and the U.S. trade or business. So putting that all together, FDAP income normally is going to be subject to this second tax regime, the 30% tax on the gross amount, rather than the first tax regime. It can be subject to the first tax regime only if it's considered effectively connected with the conduct of a U.S. trade or business. If we break these statutory requirements down into elements, we find that there are 5 requirements that must be satisfied in order for this 30% tax to be imposed on the income of a foreign person. The first requirement is that we have the right type of income. That is, it has to be interest, dividends, rents, etc., or other fixed or determinable annual or periodical income. Second, according to the statutory language, it has to be an amount received by that foreign person. Third, the amount has to be includable in the gross income of the foreign person. Fourth, the item must be from sources within the United States. That is, it must be U.S. source income. And finally, the item must not be effectively connected with the conduct of the U.S. trade or business. Only if all 5 of these requirements are met will the item be subject to the 30% tax of Section 871A1A or of Section 881A in the case of a foreign corporation. Notice that the 30% tax is imposed on the recipient of the income. However, the tax is collected through a withholding mechanism. The person paying the FDAP income, which is typically a U.S. person, has an obligation to withhold tax on the amount that is paid. As the materials discuss, the withholding mechanism is simply a way of ensuring the tax is paid, but the tax is actually imposed on the foreign person. As we discussed, the 30% tax is commonly modified by tax treaties into which the U.S. enters. We will discuss the effect of tax treaties in Assignment 4D. As the materials indicate, the imposition of a tax on gross income, which is the mechanism used here, is a departure from normal U.S. tax policy. The reason for imposing the tax on gross income rather than net income is practical. The tax is collected through a withholding mechanism. The person who withholds the tax and pays it to the government typically has no information about the recipient's tax position, such as expenses they might have incurred to produce the income. So the only practical alternative is to impose tax on the basis of gross income rather than net income. In theory, the 30% tax on gross income is supposed to approximate the tax burden the foreign person would incur if normal income tax rates were imposed on net income. As a result, in reality, let's put it that way, the 30% tax is probably higher than the normal rate of tax that would apply in most cases. This is because income tax rates have declined substantially over the years, while the 30% rate of tax in Section 871A1A has remained constant. As a result of that, the 30% tax probably is not an approximation of the tax that would be imposed on net income. We should keep in mind, however, that the 30% rate typically is reduced or even eliminated in U.S. tax treaties. Let's examine Assignment 4B. The topic is, what is FDAP income? As we know, the Code imposes a 30% tax on interest, dividends, rents, or other fixed or determinable annual or periodical income. However, the income need not be paid annually or periodically in order to fall within this phrase. The U.S. Supreme Court reached this result in the case we see on page 231, Commissioner versus Woodhouse. In that case, the author, P.G. Woodhouse, who was a non-resident alien, received a lump sum payment from a U.S. publisher for the right to publish a certain story in the U.S. In a portion of the opinion that we don't have, the court concludes that the payment was a royalty paid with respect to a U.S. copyright. Notice that royalties are not listed in Section 871A. Therefore, they are subject to the 30% tax only if they fall within the category of other fixed or determinable annual or periodical income. The court concludes that the payment to Woodhouse falls within this category, even though it is a lump sum payment. Today, this interpretation is reflected in the regulations, specifically Regulation 1.1441-2 B1 2i. Again, that's 1.1441-2 B1 2i, which is discussed on page 230. Thus, a payment of royalties, or of interest, dividends, or rent, need not be paid annually or periodically in order to be subject to the 30% tax. One issue we should also consider is whether the 30% tax can apply to income when there is no actual payment. As we know, the statutory language imposes the tax on an amount received, which is the second of our 5 requirements. Does this mean that the tax applies only if there is an actual payment of income? The answer to that question is no. The tax court addressed this issue in the case that we see on page 234 in the casebook, Central de Gas de Chihuahua, S.A. versus Commissioner, which is a 1994 decision of the tax court. In that case, the IRS exercised its authority to allocate income between taxpayers under common control. The taxpayer, Central, rented trucks to a related corporation, Hydro. Both corporations are Mexican corporations. Thus, we have Hydro renting trucks from its related corporation, Central. Hydro used the trucks in the U.S. to transport liquefied petroleum gas. Hydro did not actually pay any rent to Central. The IRS allocated income to Central equal to the fair rental value of the trucks. So, in other words, even though Central was not receiving any rent, the IRS allocated deemed rent to Central in an amount equal to the fair rental value of the trucks. The IRS argued that the imputed rent is U.S. source income, and that Central therefore was liable for the 30% tax. Central argued that the tax applies only to an amount received, and this requirement is met only when there's an actual payment. The court agreed with the IRS. No actual payment of income is required in order for the tax to apply. The court distinguishes between liability for the tax, which is imposed by Section 881A in the case of a foreign corporation, and the obligation to withhold the tax, which is merely the method of collecting it. The court reasons that even if the obligation to withhold is triggered only by an actual payment, that does not prevent Central from being liable for the tax under Section 881A. The policy behind this is discussed on page 237, and there we find the authors telling us that a holding that actual payment is required could significantly undermine the effectiveness of Section 482, where foreign corporations are involved. Such a view would permit such corporations to utilize property in the U.S. without payment for such use, and thereby avoid any liability under Section 881. So there we find the court describing the policy rationale for its holding on page 237 in the casebook. In assignment 4C, we find that certain types of FDAP income are not subject to the 30% tax. Specifically, certain types of U.S. source interest is not subject to the normal 30% withholding tax. The first type of interest that is exempt is interest on deposits. We see this rule in section 871I1 and section 871I2A and section 881D. The term deposit is defined in section 871I3. Basically, the interest that is exempt from tax is interest on bank deposits, deposits with savings and loans, and insurance companies. The exemption is designed to encourage foreign investment in U.S. banking institutions and U.S. insurance companies. A second type of interest that is exempt from the 30% tax is portfolio interest. This is defined in section 871H2 and in section 881C2. Generally, portfolio interest is interest on registered obligations. That is, debt obligations that are registered on the books of the borrower as issued to a specific person. It also includes interest on unregistered obligations, commonly referred to as bearer obligations. Now, in the case of bearer obligations, they must meet specific requirements which are designed to ensure that the interest is payable only outside the U.S. to foreign persons. Interest on unregistered obligations, or bearer obligations, can qualify as portfolio interest only for obligations issued on or before March 18, 2012. This second category of interest, the portfolio interest exemption, is designed to permit U.S. corporations to participate in foreign capital markets, that is, to borrow money overseas. And because of this exemption, U.S. corporations are able to borrow overseas at lower interest rates. Certain interest payments are not eligible for the portfolio interest exemption. First, interest income of a foreign bank cannot qualify for the portfolio interest exemption if it is received on an extension of credit made pursuant to a loan agreement entered into in the ordinary course of a trade or business, and if the borrower is any person other than the U.S. government. We find this exception in section 881C3A. Second, interest payments to a 10% shareholder are also not eligible for the portfolio interest exemption. We find this rule in section 871H3 and in section 881C3B. In the case of a corporation, a 10% shareholder is one that holds stock with 10% or more of the total combined voting power of all classes of stock entitled to vote. We find that definition in section 871H3B 1i. Again, 871H3B 1i. Note that for debt issued by a partner in a partnership can be considered a 10% shareholder for this purpose if they hold a 10% capital or profits interest. We find that in section 871H3B 2i. Third, interest received by a controlled foreign corporation, or CFC, from a related person, as defined, is not eligible for the portfolio interest exemption. We find this rule in section 881C3C. We'll discuss controlled foreign corporations in a later chapter. For now, just note that CFCs may not be eligible for the portfolio interest exemption. Finally, the portfolio interest exemption does not apply to contingent interest. We find this rule in section 871H4 and in section 881C4. For example, interest that is determined by reference to the borrower's profits for the year, such as 10% of net income, would be contingent interest that is not eligible for the portfolio interest exemption. Back in Chapter 2, we discussed the rules for determining the source of income and deductions. As we discussed, interest paid by a U.S. corporation generally is U.S. source pursuant to Section 861A1. Now, a former provision, former Section 861A1A, provided that interest is not U.S. source if it is from a resident alien or domestic corporation that meets the 80% foreign business requirements of subsection C1. Such a corporation that met the 80% foreign business requirement was commonly referred to as an 80-20 company. Formerly, interest paid by an 80-20 company, although it was paid by a U.S. resident alien or a U.S. domestic corporation, was not subject to the normal 30% withholding tax. As the authors discuss, however, Congress repealed Section 861A1A in 2010, and therefore interest paid by an 80-20 company now is generally subject to the 30% withholding tax. This repeal was one of several international tax amendments that served as revenue offsets to pay for certain tax benefits. There's a grandfather rule for existing 80-20 companies in Section 871I2. We are not going into the details of that. The important thing is that now, if we have an 80-20 company, one that meets the 80% foreign business requirement, interest that it pays now is subject to the normal 30% withholding tax. We've been considering certain types of interest that are not subject to the normal 30% withholding tax. Let's now consider certain dividends that either are currently or formerly were not subject to the normal 30% withholding tax. Recall that dividends paid by a U.S. corporation generally are treated as U.S. source income under Section 861A2A. Therefore, dividends paid by a U.S. corporation generally are subject to the 30% withholding tax. However, an exemption appeared in some former code sections, Section 871I2B and in Section 881D. Specifically, if the U.S. corporation earned a sufficient portion of its income in foreign countries, then a portion of the dividends it paid was not subject to the 30% withholding tax. Specifically, the corporation had to meet the 80% foreign business requirements, and if those requirements were met, then a portion of the corporation's dividends was not subject to the normal 30% withholding tax. However, Congress has repealed those provisions, and now, even if a U.S. corporation meets the 80% foreign business requirements, dividends it pays are subject to the normal 30% withholding tax. Second, dividends paid by foreign corporations generally, as we know, are foreign source income under Section 861A2B and Section 862A2. Therefore, such dividends are not subject to the normal 30% withholding tax, because one of our 5 requirements for this taxing regime to apply is that the income in question must be U.S. source. As we discussed in Assignment 2C, however, dividends paid by a foreign corporation can be U.S. source income in certain circumstances. Specifically, if the corporation earns a sufficient percentage of its gross income from the conduct of the U.S. trade or business. That rule is in Section 861A2B. 861A2B tells us that if a corporation earns 25% or more of its gross income from the conduct of a U.S. trade or business, then a portion of its income is considered U.S. source. However, even if a corporation meets this test, and therefore, even if its dividends are considered U.S. source under this special rule, they are not subject to the normal 30% withholding tax. We see this in Section 871 I2D and in Section 881D. So these categories of dividends are not subject to the normal 30% withholding tax. One is a former rule, and the other is a current rule. Finally, we see that certain wagering income is not subject to the normal 30% withholding tax. We find this rule in Section 872B5 and in Section 871J. These exemptions appear in part because of administrative difficulties in collecting the tax. This concludes the recorded lecture on assignments 4A through 4C in U.S. Taxation of International Transactions.